I should have just been buying Costco the past 15 years, just to be honest, and just building that into a big position. I mean, it's one of those simple stocks that if, you can just buy it and buy it and buy it and buy it and buy it, and you can just sleep well at night. You know what I mean? Like, geez. I don't have the same type of thought process as Ed Yardini here, right? Because I don't believe if we have a very nice economy in 2024, I don't believe that the Fed's going to lower rates. I just don't, even if inflation numbers are coming in good in any substantial way. Maybe a quarter point cut for something. But, it's not, if you were the Fed, and let's say you've got a re-accelerating economy, it does seem very strange to be lowering rates into an accelerating economy, which is something we could potentially have, actually, in 2024, right? Howdy, folks. Hello, chat. Hello, chat. Hope you guys are doing phenomenal. Hope you guys had a great weekend. Well, Dow's green today, S&P 500 green, NASDAQ green. But when I say green, I mean very slightly green. The Russell's up 0.15%. The NASDAQ's up 0.09%. So the moves are... we continue to see this move out of Walmart. So Walmart's red today. Target's nicely green, up 1%. I think that's a trend that will continue in 2024, in my personal opinion, where we'll see money come out of Walmart stock and move into Target stock. That's my personal opinion. We'll see how it all shakes out. Costco continues to roll, $624 a share now for flipping flapjack in Costco. I mean, it's one of those stocks. I should have just been buying Costco the past 15 years, just to be honest, and just building that into a big position. I mean, it's one of those simple stocks that if, you can just buy it and buy it and buy it and buy it and buy it, and you can just sleep well at night. You know what I mean? Like, geez. I mean, it's not the best performer in the world, but it's a dang solid performer. And I mean, as you just buy this every year, I mean, you're looking pretty dang good for yourself. But anyways, same thing actually with Monster over the years. That's been the same exact situation. Nvidia downward move here today. Nvidia, it's funny. Nvidia seems like it hasn't really been doing a whole lot of much the last few months. Let's see. I mean, you could even back it up to kind of the summer in July. And I mean, technically the stock is down from where it was, let's say mid-July right there. Down quite a bit from where it was here in August. Down quite a bit from where it was in November. So it's funny, Nvidia just, everybody's trying to figure out with Nvidia, is the growth just transitory, this crazy growth rates? Are they going to be able to keep up nice growth in 2024, 2025? And that's what everybody's really trying to figure out here. So after the bell today, we got Oracle. That's a big dog company reporting. If I recall, Oracle's a several $100 billion market cap. Tomorrow after the bell, not much going on there. Then on Wednesday, you got Adobe, the big giant that is Adobe. Great company, great stock. They're going to be reporting after the bell Wednesday. And then Thursday after the bell, we have Costco reporting. That's funny, we just talked about Costco. And also we have Lennar reporting. And then, by the way, Friday, before the open, Darden Restaurants is going to be reporting, and that could move Cheesecake Factory stock, and that could move Texas Roadhouse on the Friday trading day. Something to keep in mind.
Welcome back. I mean, it's one thing to be bullish, but that's like off the charts bullish. Why so?
Well, I don't know that it's really off the charts. It's actually consistent with the underlying trend of earnings and the stock market for years. Every now and then we do get these recessions and corrections. We certainly had a bear market last year. It was a fairly conventional one with a 25% drop. Then we made a low in October of last year, and we're up substantially since then. We had a conventional correction during the summer. And now, since October 27th, we're back in what I think has been a bull market since the year before that. And I think the economy's proven to be resilient. I didn't buy the idea that it's going to fall into recession. It's been more of a rolling recession. But earnings are about to hit an all-time record high, and I think next year's economy is going to get a big boost from productivity. Everybody talks about AI and all the other technologies. They're all out there to increase productivity, and I think that's what's going to happen.
Yeah, I mean, I'm looking at your targets, right? 2024 year end is 5,400. 2025 year end, it seems hard to look out that far, but nonetheless, 6,000. on the S&P. I mean,
Woo!
the implication here is that this isn't just a bull market. This is a new, very powerful bull market that we've started.
Yeah. Well, I've been discussing the alternative scenarios for the decade since the beginning of the decade. In 2020, I said, look, it's either going to be a repeat of the great inflation of the 1970s, or it could very well be something more like the 1920s, the roaring 2020s. And I'm increasingly convinced that it's going to be the roaring 2020s with technological innovations solving the major economic problem we have right now is labor shortages, skilled labor shortages. Productivity, I think, is going to be growing 3.5% to 4.5% within the next couple of years, within this decade. And that may sound far-fetched, but that's the kind of peak you usually get in the productivity, the last 3 productivity booms we've had. So historically, it's possible. And I think this productivity boom that I see has more going for it in terms of the ability of technology to really apply to almost any business. I think any business these days is a technology company. They either make it or they use it. If they don't use it, they're going to be at a competitive disadvantage.
How many Fed cuts do you think we get next year?
Well, again, I'm not in the recession camp. I see there's still some what I call die-hard hardlanders out there that are still expecting recession. I don't think we're going to have a recession. In that case, I think the Fed is going to cut rates twice, not 4 times or more, which is what those who are looking for recession expect. Look, I think the reason the Fed's going to be lowering interest rates next year isn't because of a recession. It's because inflation is going to continue to surprise everybody and come down substantially. We've been in the camp that has argued.
See, this is where somebody like myself, I don't have the same type of thought process as Ed Yardini here, right? Because I don't believe if we have a very nice economy in 2024, I don't believe that the Fed's going to lower rates. I just don't, even if inflation numbers are coming in good, in any substantial way. Maybe a 1/4 point cut for something, but it's not. If you were the Fed, and let's say you've got a re-accelerating economy, it does seem very strange to be lowering rates into an accelerating economy, which is something we could potentially have actually in 2024, right? So I don't know. I think that's something that needs to be factored.
Relatively transitory after all, and it's certainly come down a lot faster than has been widely anticipated.
What are you worried about, if anything? I mean,
what happened to Bitcoin? I mean, I swear it was 43,000. Was it Friday? And now it's 40,000? That's a big move.
I mean, rising deficit, not even rising. I mean, it's out of control, right?
Yeah.
Many would describe it as.
Sure.
The cost of funding that, messy election.
Right.
What, if anything, worries you?
Well, look, I pay close attention to the bears and the pessimists. They've done an outstanding job of telling us everything that can go wrong. Just they haven't been balanced and suggested what could go right. And yeah, I'm very concerned about the debt and the deficit. I was especially concerned this summer. I've been saying for a long time, I won't really care about debt and deficits until the bond market cares, and the bond market seemed to care. But there's a saying, don't fight the Fed. I think on November 1st, we learned don't fight Janet Yellen at the Treasury. She cut back on the amount of bonds and notes and bond market like that. I think the bond market also liked that inflation's come down. So on the bearish side, you have profligate, out of control fiscal policy. On the bullish side for bonds, you've got inflation coming down substantially. I think we'll be down at a 2%, the Fed's 2% inflation rate target by the second half of the year. I think they were hoping they would get closer to it in 2025.
You said something powerful there, this notion of not fighting the Fed, because it cuts both ways, as you know,
Sure.
right?
Yep.
Are we in one of those environments again where we get a everything kind of rally because the Fed becomes more friend than foe?
I think that's partly right. I think what we're really seeing here is everybody's been characterizing the Fed's raising interest rates by 500 basis points as tightening, and certainly that there's a lot to be said for that. But I think it's also been normalizing. We're actually back to normal. We had a very abnormal environment between the great financial crisis and the great virus crisis. Now we're seeing interest rates back to where they should be, where the capital markets can actually properly allocate capital So from that perspective, I think that we don't have to fight the Fed because I think they're done raising interest rates. And now the big debate is how much they'll be lowering interest rates. But I'm arguing the economy can live just fine with interest rates where they are today.
Sure, but the other argument is what's yet to come from what the Fed's already done. And right. Because what they've already done, we must be late cycle. That's the argument from bears. How would you respond to that?
Well, I mean, they've been making this argument for a while. I've been referring to their forecast as the Godot recession. It just refuses to show up. I'm not saying it can't show up. I'm not saying it's impossible to have a recession in 2024, but I think it's less and less likely. I've been arguing that we've been in a recession since the beginning of last year. It just happened to be a rolling recession. It certainly hit single-family housing. It certainly hit retailers. Now it's going to hit some areas of commercial real estate. But here we've got productivity at an all-time record high, showing signs of actually picking up in the second and third quarter. We've got construction employment at an all-time record high. You've seen the charts on the construction of manufacturing facilities. It's just vertical, straight up. There's just so much that's going right that's offsetting what could possibly go wrong.
So over the late cycle's over. We've already rolled over. It was just rolling in that rollover, so to speak. And then now we have a new business cycle underway.
Well, I think that's the case. I think that we're getting out of a rolling recession environment, and now I think we're going to see 2024 as a rolling recovery environment. I think we'll find that housing starts to improve as interest rates go down. I think we're going to discover that commercial real estate is far more resilient and can withstand a rolling recession in old office buildings in downtowns. I think we're going to discover that the consumer has a lot of excess savings after all. And it's not just what they saved during the pandemic. Households have $150 trillion in net worth, all-time record high. Baby boomers happen to hold on to half of that. And a lot of them are retiring. And guess what they're doing? They're retiring and they're spending all this money that they accumulated.
Ed, we'll talk to you soon. I always appreciate it. Thank you.
My pleasure.
That's Ed Yordenny. Up next, we're tracking the biggest movers as we head into the close. Christina Partsinevelos is back with that. Christina.
I started getting a little worried about Bitcoin and everything recently because in just last week, I had two separate people in real life, two separate friends, ask me about Bitcoin and like one's not at all interested in the financial markets or anything like that. And one of them was like, hey, my friend's telling me to buy Bitcoin, you know, he says it's going to go to 100,000. Should I buy it? And like that one never cares about anything like money related like that, like stocks or crypto, nothing to do with that. Another friend who's usually extremely conservative with their money was talking about Bitcoin the other night. And so both those situations made me say, oh gosh, like, we'll see. We'll see. Like, usually when everybody, all these random people that don't usually care at all about crypto or Bitcoin start talking about it and talking about buying it and should I buy it and things like that, yeah, it's a little concerning. It's a little concerning. So, anyways. Who said Palantir was dumping? Somebody said Palantir was dumping. 0.17%? I don't know if that's dumping today. Oracle's up, Trade Desk up. Oracle's tempting to buy calls on for this earnings. They're about to come out, but I'm not going to do it. I'm not going to do it. Nope. Kathy Wood watch list. A little bit of Red Dead Redemption out there. Obviously, Coinbase getting hit hard because Bitcoin got hit. When it comes to Coinbase, it's just, I mean, if Bitcoin goes down, Coinbase goes down. If Bitcoin goes up, Coinbase goes up. It's almost like a call or put option on Bitcoin. I don't know if it will always be like that for that stock, but it certainly is like that right now and will be for probably at least the next couple of years. Broadcom stock spikes on pace for its best day in a year. Wow, 9% move. Broadcom is one of many companies looking to profit off the artificial intelligence boom. Citigroup said it resumed its coverage of the semiconductor and software company in a note to investors on Monday, citing strength in core business and accretion from the VMware acquisition. Ooh, interesting. Broadcom is one of the many companies looking to profit off their artificial intelligence boom and has teamed up with companies such as Google, Comcast to design and build chips and other infrastructure for certain AI applications, including Google's custom tensor processing unit. However, it's not competitive with Nvidia in providing GPU used to train cutting-edge generative AI models like those that power OpenAI's ChatGPT.
Mark Arbiter, the technician over.
Oh, by the way, here's price targets for the S&P 500 from different investment banks and whatnot for 2024. I meant to show you guys this earlier. So right now, keep in mind we're at S&P 500 like 4,600 or so. Right now, 4,600. Right, yeah, 4,622 technically. So let's just call it 4,600. And so, oh, of course I deleted it. Of course I deleted it. So JP Morgan's very bearish on the S&P 500 for next year. They think 4,200, which is down 400 points from here, right? Barclays and Morgan Stanley both negative as well, 4,500. So that would be a down year for the S&P 500. Wells Fargo says S&P 500 is going nowhere in 2024. Goldman Sachs says slight gains and very slight gains in 2024, right? And then on the more bullish side, you have Bank of America and RBC at 5,000. Okay, not crazy bullish, but bullish. Citi, Deutsche Bank, and BMO are a little more bullish, 5,100. Oppenheimer's 5,200. So,
Short-term fixed income. At what point does that shift?
See, Oracle. Oracle's tanking,
we don't
down
want to
5%,
chase
folks.
This we'd rather fade it. And really, when
Something's
you
going on
look
with
at the
Oracle.
Facebook last week, I think the Fed pointed out just exactly the things that have been concerning us. And as I look at my list, consumers are pulling back. They're more price sensitive. The labor market's easing. Credit's tougher to get. Delinquencies are rising. Corporate power pricing.
Jamie
power
Dimon,
is
he has
waning.
been pretty bearish.
Those are the things that we've been concerned about for a while. They've taken a little bit longer to probably play out than we initially thought, but we're still in the camp that we're at the
Oracle now down
6% here.
Not good.
This 45.80 to 46.30 is some pretty good resistance. Obviously, we're going to test 46.30. We're right there. But we don't think we're going to see that carry much above that. And some of these issues that we see as headwinds are going to have negative impact in the market as we move into 2024.
Okay, watching that. We're also watching Oracle results are out. We're going through them. The stock's initial move is down by a little more than 5, maybe 6%. We'll see what the numbers say. Sam, back to you and your S&P views, 49.40 or fight, I guess, for next year for the Oregon folks out there.
Hey, come on. Bring the numbers out, CNBC. We know you guys got them. You guys always have them before everybody else has them, magically enough. Okay, here we go. Oracle. So, Oracle, GAAP EPS 89 cents, non-GAAP EPS 134. Q2 total revenue 12.9 billion, up 5%. Not that good. 4% constant currency, not very impressive for Oracle. Q2 total remaining performance obligations over $65 billion. Q2 cloud revenue 4.8 up 25%. Infrastructure up 52%. Cloud application up 15%. Fusion Cloud up 21%. NetSuite up 21%. Okay. So where are all the problems here? Demand for our cloud infrastructure and generative AI services is increasing at an astronomical rate, says Safara Katz, Oracle CEO. As measure of that demand, Oracle's total remaining performance obligations, RPO, climbed to over $65 billion, exceeding annual revenue. Our cloud business are now roughly at nearly $20 billion annual revenue run rate, and cloud services demand continues to grow at unprecedented levels. Business is good and getting better. Oracle's in the process of expanding 66 of our existing cloud data centers and building 100 new cloud data centers to meet growing demand, said the Oracle chairman, CTO Larry Ellison. We can build our new data centers by very rapidly operating them inexpensively, because they are highly automated and identical high-performing RDMA networks and the same set of autonomous services. In the next few months, we are turning on 20 new Oracle Cloud data centers collected and connected with our Microsoft Azure. Simultaneously, we're building dozens of data centers in countries all over the world. Demand is over the moon. I don't know how I feel about that demand is over the moon. Like, you sound like you're pumping it a little too much, okay? Maybe a little too much pumpy? Maybe a little too much. So, cloud services and license support up 12%. What is that in U.S.? Oh, in U.S. dollars, yeah. Up 12%. Okay, that's okay. Is that what we're talking about? It's over the moon? Because it just doesn't seem like it. Cloud license on-premise license was actually decreased 18%. Okay. But actually, we want to see constant currency. This matters more. So technically 19%. Hardware was down 12%. Services down 3%. That's not good. That's not good. So interest expense up 4% year over year. Net income for the company up 39%. That's a very strong, nice number there. Good for them. 39% net income's up. Very nice. And EPS looks to be up very nicely year over year. So that's good. But they clearly have some weaknesses in their business. By the way, the really bad news with Oracle is their balance sheet is really poop balance sheet at Oracle. That's the one bad news in regards to this stock. Let's find their balance sheet here. So, they usually load it up on debt. So why do they just put it all under total non-current liabilities? That's ridiculous. Oh, there we go. Notes payable and other borrowings, non-current, $82 billion. So that's the problem. They got a huge debt load. And it's not like they got crazy cash. They have less than $10 billion of cash. So obviously their debt far exceeds their cash. So, but anyways, let's hear what they have to say about Oracle here. I'm sure they've talked about it now.
Up in either of those two numbers, I think, will jar investor confidence.
Okay, now let's get to those Oracle earnings. Christina Partsinevelos has the numbers. Christina.
A mixed report for Oracle right now. You
Dude,
have earnings per share of $1.30.
What kind of music is that? The music was better before. Come on, CNBC. Like, it sounded way more epic, like the prior earnings release music.
Light at $12.9 billion. If you break it down according to categories, there's 4 categories. It seems like 3 of those 4 are misses. The only one that beat was hardware. That came in slightly higher, but services was lower. Cloud licensing and on-premise licensing lower. Cloud services and license support also lower. In this actual release, we aren't getting any outlook just yet for the following quarter, but you have Oracle CEO Safra Catz saying, and I quote, "Our cloud business is at nearly $20 billion annual revenue run rate, and cloud service demand continues to grow at unprecedented levels. Business is good and getting better." But nonetheless, you are seeing just a negative reaction to stock, down 7%, even though it did climb 40% year to date. So a beat on the top.
Yeah, by the way, anybody in the chat own Oracle stock, or is there anybody interested in potentially owning Oracle stock? Let me know in the chat.
Top line, a miss on the revenues.
All right. Okay. Christina, thank you. Now, Scott, we have always been used to getting Oracle's guidance on the call, so investors have to be careful about just trading the release. At the same time, in a lot of enterprise software names, think about MongoDB and some others last week, we did see those stocks take an initial move down, even if the numbers were decent, even if the guide was pretty strong, depending on, whether investors wanted to take profits.
Well, John, when we talked about, when I talked about fading this rally, if you look at technology, if you look at communication services, if you look at consumer discretionary, those three sectors have done really well, obviously, this year. Those are the ones that we would tend to fade in here. And I think, I'd like to say something, Sam mentioned CPI. What we're concerned about is that core CPI hangs up here 4%, 3.74%. I mean, the Federal Reserve's not going to, but it wouldn't surprise us if core inflation hung up there. And certainly if we get a number that's dicey tomorrow, you combine the resistance that we're heading toward.
Tomorrow, obviously, we'll talk a lot about the CPI numbers. We'll get into that release and go over all that heavy tomorrow in tomorrow's live stream.
You could expect some downside here in the market, at least in the near term.
Okay, we'll leave it there for now. Scott, Sam, thank you.
Thanks, John.
Is behind? Are they just talking about revenue?
Ooh, okay, this is what I want to hear.
Microsoft
are gaining share.
This is what I want to hear.
Was
an analyst of Oracle going over this
hardware.
earnings.
What call? Joining us now is Jeffrey Senior.
This is what I want to hear.
Brent, how much of a concern, particularly, is this revenue number and all of these business lines, maybe except for hardware? What could they say on the call that would change sentiment about this?
Hey, John. Yeah, it was a revenue miss. Q1 was soft. Q2 soft again. OCI, which is their cloud infrastructure business, which competes against AWS, was 52% growth. The Street wanted to see over 55% growth. And last quarter, they did 66. So top line miss, infrastructure miss. I think Google, Microsoft, and Amazon are gaining share. So it's definitely concerning. We'll have to see what they say on the call. And they've said that they don't expect AI revenue till mid next year, which is implying that to many that their infrastructure isn't ready for these AI workloads. So I think there's a lot of open questions. We're going to have to get a better answer here coming up on the call.
At the same time, though, Brent, we're starting to see application players, ServiceNow, Microsoft, others that are rolling out AI-enhanced offerings now. Does that mean Oracle is behind? Are they just talking about revenue recognition in a different way? Is it too early to gauge how much relative benefit Oracle might get out of AI in 24?
Oracle's behind. There's no question, right? They're behind the cloud, which makes them behind in AI. So if you think about what's happening in Amazon, Microsoft, right? They have the infrastructure to then do the workloads on AI, and Oracle's.
So basically, this man kind of saying that like Oracle's a lot of talk, a lot of bark, no bite, maybe?
Convince their customers to move to their cloud. So while they're behind, we do think Oracle has a shot and the capability to be one of many in a multi-cloud world, right? It's not going to just be Amazon. It could be Amazon and Oracle or Amazon and Microsoft. Unfortunately, they're a rounding error relative to the overall equation. And what you've seen out of Amazon, good numbers, Microsoft, good numbers. Now you have two bad quarters in the effectively the wave that AI is about to hit tells you that those customers may not be moving as quickly to Oracle. I believe they're moving to Amazon and Microsoft, and those are our two best ways to play this. Oracle will benefit, but not at the same magnitude of those other two.
I mean, for Oracle specifically, how much of this is going to be and I realize that they're on their own fiscal reporting schedule, so I'll say a calendar 2024 year. I ask this because the commentary in this release from Safra Catz that as a measure of the demand for generative AI services and cloud infrastructure, that remaining performance obligations climbed to over $65 billion, that exceeded annual revenue. And then commentary here from Larry Ellison about the fact that they're working to expand their existing cloud data centers. So I wonder how much of this is that they're in this investment phase, to your point, versus realizing the actual monetization of that process, and if so, what that means in terms of permanent loss of market share versus delayed loss of market share.
Well, remember, Oracle's been losing market share in cloud for a long time, so this isn't necessarily new. And backlog is a measure of committed contracts, but at some point, they're not going to be able to sell that because they can't recognize revenue. So, I mean, at this point, I just say that I think overall what we're dealing with is the same thing we saw in cloud. Oracle was late. They caught on. There's two leaders. and the others are growing. I mean, if you put this in perspective, how big these other companies are and their growth rates, they're still, I mean, Oracle just grew, 4%, and the rest of the industry is growing at double digit, and they're multiple times the size. That basically tells you that they're behind.
So Brent, quickly, do you keep a buy rating on the stock then?
Yeah, I mean, this we think, again, in a multi-cloud world, they're going to benefit. This is more of a value, cheaper way to play it. There's not as many people invested in this as Amazon and Microsoft. So we think they will benefit. Stocks worked pretty well year to date, but certainly is going to give some up on this. And it's been two, disappointing quarters back to back. So you can't sugarcoat that. It's going to be down tomorrow. All
right, and it's down almost 9% right now in after hours. Brent Thill, thanks for joining us. We'll keep a close eye on that call.
Holy smokers. That's no jokers. Look at Oracle stock. Woo! Getting a smokers. Down nearly 10% now at this point in time, Oracle stock is. So, the thing that makes Oracle interesting, oh, by the way, let's check this out real quick. Oracle revenue misses, shares fall. Oracle market fell, blah, blah, blah. Company reported EPS, $1.34 compared to analyst expectations, $1.32, $12.9 billion versus $13 billion. Cloud revenue total $4.8 billion versus estimate of $4.86. Okay. Yeah, a lot of the same info there. So, but the thing that makes Oracle compelling as a stock, right? I'll show you. Okay, I'll show you. So, right here. You compare it versus a lot of the other big techs, and you're not going to find usually, forward P's kind of under 20 for many of the other big techs. And so when the company does still have growth, when it's growing their earnings per share pretty strong, and when you got it under 20, that's what makes the stock compelling, right? And obviously tomorrow should be cheaper than whatever it is because the stock should be down very nicely tomorrow. But yeah. So let me grade their earnings real quick. I'm going to grade their earnings. I'm going to go grab my iPad and I'll grade their earnings here. All right, so this is Oracle's income statement graded here. B grade for Oracle. So revenue's up 4%. Decent. It's better than revenues going down, but it's certainly not the most exciting. They definitely kept expenses very well under control. I mean, total operating expenses actually ended up flatlining for them year over year. So that's good. That's definitely very good, right? So their operating income grew quite substantially. They grew 15% year over year, and then their net income grew 39% year over year. So I'll grade them a B. Certainly could be better in some areas. Revenue growth and stronger operating income could be better, but decent earnings from Oracle. I'd give them a B overall. But the problem is people don't just play that game, they also play, well, how much are you beating by, what's your guidance like, and so I think that's where probably the turnoff was there. Anyways, that covers today's video. Appreciate y'all joining me as always. Thanks so much. I'll likely get to work on a video for the main channel for tonight. Other than that, folks, much love. Thanks so much for being here. As always, make some money out there, and then when you're done, make some more money, and when you're done, make some more money, okay? All right, guys, much love as always. Appreciate you. See you tomorrow. It's only a day to wait. Tomorrow. And also, see you on the main channel later tonight.